Hey everyone, thank you so much for joining. My name's Denise Loria. I'm the Special Projects and Operations Manager at AFC. We're thrilled to have you guys join us today. We're going to be talking about fraud. And so this is the first webinar in our new series, Webinar Wednesdays, which is a new policy summit series that we kicked off. The reason why we did it is we want to kick off the momentum for the policy summit, which is taking place November 18th in Washington, D.C. Our agenda is jam-packed, so we figured let's get the conversation started early. So when people get on site, we want people talking and more buzz. So today we're kicking off the series with the topic of fraud, and we have a great lineup. This webinar is in collaboration with our legal advisory partner, Ballard Spahr. So I'm going to kick it over to John because there's so much to cover. So take it away, John.
Awesome. Thank you, Denise. So Ballard Spahr, we at Ballard Spahr, we appreciate the opportunity to collaborate with AFC and representatives from three of AFC's diverse and impressive membership. I am, again, John Socknet. I'm co-head of Ballard's Consumer Financial Services practice, and I get the pleasure of moderating this webinar, which means mostly staying out of the way of our talented presenters, who include Joseph Schuster. He's a partner in Ballard CFS Group and resident in our Denver office. Michelle Prohashka, who is Chief Banking and Risk Officer at Nimbus. Dalab Ohal, Vice President of Product at Verify, and he'll correct me later about my butchering of the name, but I tried. And Eli Wachs, co-founder and CEO of Footprint. You will be able to, there we go, there's all our pictures. And I think we'll distribute the deck to everybody. And if you want to read more about them, you can read them here on the slide. And there's also a link on the deck that will take you. And I guess we'll fix it for Joseph. Joseph is the one who doesn't have a live link. For those of you who aren't familiar with Ballard, here are the various resources that we make available to our clients and industry friends, our various monitors, and our blog, and our podcast. All right, so on to the important stuff. We're going to spend the balance of this hour, and I did that quickly, so we've got almost 57 minutes to talk about fraud, the ever-evolving threats, and the corresponding prevention and defensive strategies and tools that can be put to bear. We're going to get a bit more in the specifics about numbers in a little bit. Michelle was kind enough to share some really interesting stats with me that I'll share with you in a little bit. But it may not be surprising for you all to know that more than 50 million US adults have reported losing money to an online scam or attack. I would suspect that is an underreported number. Quick anecdote, I have a neighborhood friend who is a sophisticated attorney at a private equity firm, and he got scammed by someone in relation to, I think it was his Venmo account. And it can happen to anybody, and we'll sort of talk about that some more. Right? Fraud's everywhere. Fraud schemes are becoming more sophisticated. All good old-fashioned fraud still alive and well. So to kick us off, I'm going to ask Joseph to sort of tee this up for us, and then everyone in the audience, this is meant to be collaborative, so you don't be surprised when our other panelists chime in, and if I go too fast on a screen, please, presenters, call me out and I will go back. So with that, Joseph.
Thank you, John. Yeah, and I'll just give a little background on why we're doing fraud as part of the policy webinar series. And I think the big reason is that we are seeing, you see both traditional types of fraud, which I think the previous slide talked about people taking money from ATMs. That's just your everyday check fraud. That's happened for many, many years. You see things getting more sophisticated. You see technology changing, having chips in credit cards. I guess it's not that new, but that hasn't fixed things. You see then, and this is particularly relevant for the American FinTech Council, the evolution of new products. We have digital wallets now. You no longer just have somebody selling something and somebody providing financing. Now maybe there's a credit card issuer, there's a merchant, there's a digital wallet in between. You also have the network. How do all those things come into play? In some cases, the laws are being used for the benefit of the fraudsters. And so we are continually receiving questions from our clients about how they can use new tools to combat fraud. They are presenting new types of fraud that they are seeing and asking how those can be addressed. And I think that's the real benefit of this webinar. That as you look at some of these things, what are the potential liabilities if you're on the credit provider side, if you're providing the digital wallet, if you're providing some other type of service, and you're being the victim of fraud. We have heard in the call center space that there is now AI voice that is calling in pretending to be consumers. There's a number of these different things. Fraud takes a large form too. When you think about fraud, it could just be closing somebody's account, and you might close it and say it's because there's reputational risk. That's no longer something that you can do. That becomes a buzzword of closing for reputational risk. So really having things buttoned up with respect to how you're addressing fraud from a legal perspective with all these tools that are out there, I think is very valuable. With that, John, I'll turn it back to you. Maybe you and Michelle talk a little bit more about what we have on this slide.
Yeah, for sure. And then I said we talk about data, and so again, Michelle was kind enough to share these with me, and I'll do them quick, and then I'll invite Michelle to talk about some thoughts on social media and fraud. But so here's some other data points. In 2024, U.S. consumers reported $12.5 billion in losses to fraud, up about 25% over 2023. Of that, $5.7 billion was lost in investment scams. That's the lion's share of it. And then imposter, scam, social engineering category losses, and we're going to spend some time talking about that in a bit, almost $3 billion in 2024. And the last point here, consumers reported losing more money via bank transfers, so payments by push payments, than via credit cards or other payment methods, which is interesting. And again, we're going to, not surprisingly, talk about that in a little bit. So, okay, enough of the data. Michelle, again, you had shared some thoughts with me about the impact of social media on fraud, and love for you to share those thoughts with the rest of the group.
Yeah, I think there's a couple things. One, I think, Joseph, you mentioned the piece of reputation risk and kind of the role that that's playing in how we make decisions about what we do with fraud. And I think that's something that absolutely the industry is seeing on the rise, and in the decisions that we make about how we balance customer friction with good activity versus bad. How do you stop the bad guys while enabling your good customers in that experience piece? I think in social media, with the rise of reputation risk, we're seeing the impacts of that too, right? Handling a fraud issue or problem, or making a decision that maybe your customer doesn't agree with, can have a massive impact. And that is for both the good and the bad actors. One of the things that I think we see, and now more than ever, is where, to that point, fraudsters will manipulate that reputation risk. They will go viral on social media. They will leverage different channels of urgency and communication to kind of hedge against their banking partners, to say, hey, if you don't handle this in the way that you ought to, or I believe you ought to, I may raise a risk of a regulatory issue, or I may complain to your regulators, or I may make a difference. In terms of the impact that you feel in an online presence. I think the other thing that we are seeing too is also the rise in how consumers and customers and fraudsters alike may think about what fraud is. For those who, millennial, Gen Z, et cetera, who might be a little more heavily invested in, say, the TikTok side of the world, one of the biggest things that you can find on TikTok is fraud disguised as hustles, right? In that previous slide that talks about Chase and the ATM fraud, that really was just check fraud, but it was poised as like, oh, here's a way to get free money because Chase made a mistake. No, Chase didn't make a mistake. They had funds availability policies that those people were exploiting, right? But to those who participated in it, sure, there were a series of them who knew what it was, but the others may not have. They may have seen it as a potential glitch, as a potential piece that to them felt fairly victimless in terms of who loses when those policies are taken advantage of. And all of that, I think, ultimately comes back to the influence of social media, how we're thinking about the applications that we apply to the role financial institutions play, but then also about the information that their consumers share online too.
Great. I'm going to switch the slide, but before I ask Nalab to kick us off and talk a little bit about the types of fraud, Eli, Nalab, any additional comments, anything you want to share just as we sort of tee this broader topic up?
Yeah, just a few things. I think I completely agreed with Michelle. Check fraud is such a simple type of check fraud or fraud type that we often see when we talk to banking and credit union partners at Fiverity. It's almost sometimes it takes us aback. We're expecting some sophisticated fraud schemes, and what we hear is check fraud is on the rise. And when we peel the onion a little bit, we realize, the social media having a large impact on how tactics and procedures are disseminated across the larger audience, and that can then be consumed and then looked at, potential victims where there might not be risk policies in place, and then that's a role that social media is playing, and it's sort of supercharging the amount of threat vectors that we notice on our at our customers. Just check fraud being one of the traditional fraud methods. I mean, here on the list there are other traditional fraud mechanisms that we see often with our banking partners. There are certain items here, for example, friendly fraud, where you are sort of impersonating your roommate, your grandparent. We actually have seen a lot of rise on this on the crypto side of friendly fraud, where wallet identities are hidden when you're connecting a bank account to the wallet for getting a line of credit, what have you. Friendly fraud on that side of things as well. And then some other vanilla fraud that we see and has grown in a lot of sophistication is around account takeovers and synthetic identity fraud. There is a slide we'll go over on what exactly a synthetic fraud is, but that's something that comes and goes in waves. And if we take a deeper look into just the evolution of synthetic fraud, it has gone from synthetic fraud that is SSN based, as opposed to synthetic fraud that now has deepfakes and other AI capabilities associated with it.
The only thing I'd maybe add two things. One, we've seen fraudsters become a lot more sophisticated. This is no longer your email from a prince in Nigeria that has told you that you've inherited a lot of money. These are professional organizations. If you look at the Golden Triangle in Southeast Asia, you have very specific groups here that are huge corporations. There's a group in Cambodia, the Hui One group. Their ties are to North Korea. And it's thought that between 2021 and 2025, they made about $4 billion from romance scams. If this was a company, they'd be listed on the New York Stock Exchange. That's an unbelievable amount of revenue. And then there are geopolitics involved as well. So China was getting hit with a lot of these romance scams. And it's thought that the government essentially started allying with juntas in the civil war in Myanmar to attack these centers until they agreed to start shifting romance scams to the West. But that's one thing. These are very professional. And the second is, I'm sure we'll talk about AI today. There's a lot more for bad actors to do with AI than good actors. To study fraud, to study any space, I think you need to study the P&L. If you look at the P&L of a fraudster, their COGS were how long does it take to create good identities that we can create accounts with. We're a vendor. We don't use AI to detect if an identity has been tampered with. Anybody who says they are is lying, because that's not a good use case of AI. Conversely, it's really good to use Gen AI to create good fake IDs. So that's the other thing, which is that when you think about the AI arms race, AI is good at manual review. We use it for manual review to say, is this AML hit a false hit? Can we compare this proof of address document? So those are the two other trends that have really changed the way to think about this in the last few years.
But before we go on, John, if I may add just
please.
one thing on the last slide. Of the traditional fraud types, I'd say the friendly fraud at the bottom is the one from a regulatory perspective that can be the most concerning, and it can slip by. While it may not initially have the same, I like what Eli said about the P&L as you think about these, it may not have the largest P&L hit initially because the financial institution, the non-financial institution might not be subject to, may not be out the funds initially. But when you think about friendly fraud, it could take the form of somebody impersonating somebody else. It could be as simple as somebody using somebody else's credit card at the same address. As you look at the payment card rules, one of the ways that you can verify whether or not it's an unauthorized use, which is subject to regulatory requirements, is to look at does the address match the address where the card holder is, and it does in that case. But that might not be enough as you think about fraud. It could be that there's a caretaker who does not have authorization, and is taking advantage of somebody who's elderly. We're going to get into the romance scandals. We'll get into elder abuse as we continue this, but I think that friendly fraud, or sometimes called first-party fraud too, can be something that can be very concerning. Just from a UDAP perspective, if you're blocking transactions, closing accounts, or taking other actions against people, those are the things where people will complain. And we do see states getting active in these areas as well. Just because I was talking a fair amount about creditors, keep in mind for the non-banks too that you have account takeover, you have cyber fraud rules, the FTC has safeguard rules, like those same types of things come in. And I think that just the other types of traditional fraud and other types of fraud that we're going to get into, they're fraud plain and simple. This one, there's an actual customer involved. That customer may be a victim if the bank pushes back such that the creditor or the non-bank is not a victim. But thanks, John.
Yeah, thank you. So we've already started talking a little bit about emerging fraud trends, and there are lots, and we're going to touch on a couple of these. We're going to do a deeper dive on 2 or 3 of these. But again, and synthetic identity fraud and lab, you wanted to talk a little bit about that, and then I'll ask Michelle and Eli to jump in.
Yeah, absolutely. So synthetic identity fraud at 580, we think about this in impersonation and mixing of real and fake personal data. Typical categorization of synthetic identity theft is first party and third party synthetic identity. So first party synthetic identities are when your name and date of birth is associated with some other SSN. And there are a lot of these quote unquote like credit clean companies that help you to create like CIPs that is then registered into with credit bureaus. With weaker checks, those synthetic identities typically get by, and those are ones that there is some intent of committing fraud, so that speaks to the first party, but then it utilizes a synthetic identity of that identity itself. And then the third one is third party synthetic, which is what is more commonly known. So you're using somebody else's SSN, typically somebody that's not yet eligible for credit, and utilizing your own or somebody else's name and date of birth, creating a fictitious account. And there's often when we talk to customers, there is some like, how does this even like happen? What is the first point of initiation? And this is where a few years ago, authorized trade lines were a big channel to go and associate your identity with, and that creates some legitimacy. You start creating some making some unsecured line of credit, creates this sort of cyclic effect where it gets registered with credit bureaus, and then that's been utilized, and over a period of 6 to 7 years there is enough legitimacy. We've seen when synthetic identities are ready for bust out, they permeate across an average of like 10 institutions, and the loss amounts are extremely high. 6-figure amounts is what we have seen.
Thank you. Well, the next one on here is romance imposter scam. So Michelle?
Yeah. So on these ones, I think they get lumped together a lot based on some similar trends, but they are kind of distinct in terms of how they're operated. The romance scams, primarily are playing on kind of this grooming phase, manipulation and isolation. And there's a very big piece to romance scams where a lot of the losses that when we do find out about them, which I think, John, to your comment, I think these go underreported a lot because they do play on kind of a sense of shame and this feeling that if I've had this loss, like no one else could lose this in this way. But what it forgets is that they play so heavily on kind of grooming, isolating, developing this very unique relationship. It's sometimes very prolonged. And the losses when they tend to happen tend to be very big. And those are the news stories where we see that someone mortgaged their house. They spent all of their retirement money. They made decisions that really, truly had lifelong impacts in terms of their ability for finances in the future. Imposter scams play a little bit of a less of that. You might see some that play a little bit on the romance piece of, we hear the stories of like manipulating AI to say, hey, I'm a relative and I'm stuck in jail and I need help to get out, or I need something like that. But these can be as simple as I'm a trust advisor. I'm your fraud department calling. Hey, did you authorize this transaction? I need you to give me your card number in order for me to investigate your activity to file a dispute. And These ones tend to play a little bit more on the sense of trust as a party of authority, someone that you would maybe inherently kind of trust to be giving you accurate information, and someone that you might be more willing to give that information to, but they pair it with urgency. You're going to lose something, something bad's going to happen. And both of those really play onto that piece. And then I know the third one that we'll spend some time on as well is that authorized push payment. This is, often a little more first party-ish. These are probably the harder ones for banks to make decisions on, because the individual losing out on the scam side of this is usually your customer. But this is harder because sometimes these payments, they are authorized fraud in a sense. And so I'm sure we'll dive into this with Joseph and John and the rest on kind of the sense of where do banks' liability fall in those, the Reg E side of unauthorized activity and authorized, but maybe still kind of unwilling or unknowing activity. So that's one that we're seeing a lot more, especially when you can debit or pull funds from other parties.
The third one we're going to do a deeper dive on in a little bit is AI. I've just got a question, and I don't know the answer to this, and I guess lawyers are never supposed to ask questions they don't know the answer to, but I'm going to do it anyway. This last bullet here about the resurgent in check fraud. I'm curious as to y'all's thoughts on why. I mean, it's the old-fashioned, right? But any thoughts on why we're seeing a resurgence in good old-fashioned check fraud?
I think I'm curious on Eli's take here, because I feel like he'll have a good answer on this. I think in part we find that one of the things that at least we see, and we do act as an outsourced fraud support and kind of managed services side of the world, and in the fintech that I work for, is one of the things that we find is criminals are quick to move. They are more sophisticated, but they can figure out when they're being found out. And so if one channel doesn't work, they'll revert to others. I think there can also be a bit of a resurgence in the sense that we've moved more digital. So there's a different channel to commit that fraud, but there is also the opportunity of, I think banks are feeling a little bit more pressure in the instant payment side of the world to make funds more readily available, and checks still take a little bit to come back and give a good or a bad response in terms of funds returns. But Eli, I'm curious on your take.
It's daunting to go out. I would have pretty much said everything Michelle just said. And before that, I think Michelle made an excellent point about the shame on romance scams. I think you see that with a lot of scams, like fraud. So there's an argument probably that the numbers are bigger than we think because of the amount of people who are afraid to even say they got scammed. For checks, it's very well said. Fraudsters are smart. I would actually say the check fraud's part of a bigger theme of in-person fraud, which may sound kind of silly, but email is a good example. We've seen a huge rise of banks that we work with wanting better tools to verify people in branch because they've spent a lot of time and money over the past couple of years building digital tools. So what do fraudsters do? They go in person. An article came out yesterday about the rise of fraud in tenant screening, which means another good example. Fraudsters are going to move where less is being invested. That can happen because this person showed up to tour my apartment. What do you mean it's not the same person? So I think this is part of a broader theme that we see of in-person fraud actually on the rise, and checks are a good example there of kind of like how do we use more physical things to do this with. There's also one other thing, is that there are just less models, which may sound silly, but when you think about checks, the reason why there are a lot of companies such as us that do doc tamper detection for passports or driver's licenses, there are templates. New York State has one license, and we know where the hologram should be, and we know when it changes. We know what year it changed. Not the same for checks. There are thousands of banks in this country. There are a lot of checks out there.
So let's transition now to how in the heck do we address these emerging fraud challenges? And I'm going to ask Joseph to kick us off. And then again, please, I know you won't be shy about sharing your own thoughts and experiences. So, Joseph?
Sure. Yeah. So, and I'd say as we think about addressing these, it kind of comes in from some of those different items that we were just talking about, and some of them are difficult to figure out, when they are fraud and how to address them. So, as we think about addressing the fraud challenges, you're thinking about it not just from the entity's perspective, but also the customer who was involved in this as well, who was the victim of fraud or who is claiming fraud. As you think about like the romance scams or the authorized push payment fraud, when does an authorized transaction become fraud? In a romance scam, maybe they thought it was going to work out, like it was true love for that weekend. They went out, they did a lot of shopping, all of those purchases were authorized at the time. They thought they were going to spend a life together, and then things just didn't work out. When is it that is just, a bad love story, as opposed to there was intent to do that? And how do you know that when the person's calling in and saying, hey, I made all of these transactions and now the person's disappeared. They're not calling me, they're ghosting me, I guess is what they're saying these days, in relationship circles. But like, where is that fraud and where is it just buyer's remorse? So I think as we look at these things, how you're doing that, I think that everybody else can talk more about the alternative data, but I will say, how that's being used. Some of the oldest laws that exist are still coming into play on these things, like the FCRAs. People are saying, we're just getting privacy laws for the first time. The FCRA has been around for a very long time. It was the first privacy law that was out there, and it is sometimes something that we have to navigate as we look at fraud challenges. If you're looking at the person's phone number, if they're using a mobile phone, or just other fraud items that might also fall within the category of being a consumer reporting agencies. Compliance systems, I think, are the best ways to sometimes identify these. If you're identifying different trends that are happening with your customers along the way, you might be able to flag and say, hey, we're noticing some unusual activity. Is that correct? And you can stop some things earlier on. The person might say, it's unusual because I just met this person and we're in love and all of this, and maybe you can ask more questions then. But then if something does happen, the institution has been involved earlier on. But I think that the compliance systems one is also important in the current environment more than others, because having objective standards is valuable, not just from how you're declining transactions, closing accounts, making sure that you're not doing something that could be seen as problematic from somebody who takes a view on something as reputational, versus something that is specifically fraud. Some of the other items on here that we're seeing in terms of addressing emerging fraud challenges are, and this relates, I'd say, to the authorized push payment fraud in particular, are the security standards. You think about security standards in the wire context a fair amount. Above a certain amount, you'll end up with a token that has like extra security things. But what if you're talking to somebody over the phone and your customer provides their login credentials to that person? They log in, maybe they give them the number from that little RAS card that they have to do a wire fraud, or they're able to do an ACH from the account. All of those security procedures have been put in place. You have dual factor authentication. All right, you got a text, person's on the phone. What was the text number that you just read? So I think the more that you can invest in those security standards, and some of what used to be good, I think as some of the other panelists have said, fraudsters are finding a way around. We're continually developing ways, and I'd say that there are ways under the FCRA, under the FTC's rules, and they want you to identify fraud and stop fraud, report fraud, all of those types of things. So finding the way to do it within the rules is important. However, running afoul of those rules is also problematic. There are cases out there, massive consentors in the tens of millions of dollars from banks who did stop fraud, but they stopped it in the wrong way. States have gone after people who have stopped fraud, but they've stopped it in the wrong way. We regularly have clients who say, we know that this is fraud. Here's how we know. All right, that way doesn't specifically work because it could be considered discriminatory, or runs afoul of the FCRA, but you're able to get at the same way in another way that follows all of these different legal considerations, I'd say, just as we consider addressing this. I saw a number of other panelists went off mute, so I'll pause there.
Yeah, absolutely. One of the things that is listed here, which is very pertinent, and the way we think here at Fiverity, is increasing collaboration and offering continuous monitoring on existing accounts throughout customer lifecycle. I think in terms of increasing collaboration, we tend to think in the terms of passive versus active collaboration. And then they sort of connect to each other in terms of understanding the overall ecosystem of fraud lifecycle, even any other type, traditional or emerging types of fraud. Shared intelligence is typically sourcing it from multiple data sources, trying to create a narrative, and then disseminating across the community that can learn and then update as new evidences are emerged. Joseph very rightly talked about there are right ways to stop fraud and wrong ways to stop fraud. And if you would have done it the other way, it would have been more impactful, less discriminatory. How do you get around it? There are pockets of information that exist, but all of that data lives in a very siloed fashion. And traditionally, integration has been one of the largest pain points for all of our banking and credit union partners in order to consolidate that information and create that layer of intelligence that can be disseminated. But all of that data is of very little use if it's not very actionable. And that's where we urge our partners to leverage on 314B, leverage the writing narratives on SAR based on this source information that really helps downstream prosecution, that helps in better effectiveness in collaborating on 314B. I do not want to go into a tangent, but there's this entire industry assumption that 314B is unresponsive, it's voluntary. It's a fantastic tool if context is already in place when you're sending a request to to the requesting institution, rather than sending a vague 314B request. And all of that information, like how do you send that information that makes it really actionable, is based off of the sort of a shared collaboration layer that we really think has been very impactful in some of these addressing these emerging fraud challenges.
I just have a very quick anecdote. There are actually some very simple solutions here. Monzo, Revolut, Nubank, Robinhood. Now all will say they're not going to call you. So if you get a call, it's on the app. And then if you're on a phone call and you go on the app, you see a banner that says, "We will not be calling you outside of the app." So like that's what I'd say. Like there's a lot of fancy stuff that I can pitch you from Footprint and I can pitch you. It's actually, I think, sometimes pretty simple things. Like I think those are leaders in just saying, if you're on the phone, how do scams happen on a call? Great. We're only going to call you from the app.
Really good point. Michelle, anything you want to add to, here? I know you've got plenty to add, but
Yeah, no, I know we've got a lot. I think, the only other thing that I would add is I think for the compliance side of the house, which sometimes when we think of fraud and compliance, we separate them out quite a bit, is ultimately, I think that on the compliance side of the house, one of the things that we have to acknowledge is that we file 1 million SARs and we haven't really figured out how to do that effectively. And so one of our tools for fraud is to get effective SARs and suspicious activity generated over to parties who are willing to prosecute. But right now, I think a lot of times we've given them kind of needles in a haystack, to the point that for financial institutions as an industry, there is a lot of great work being done, but we have to kind of find the middle balance of how to get them information that they can action and decision to make a difference. Because for everyone who pops up, there's another 5 who comes that way. And so how we work on that in tandem is something that I think the industry will have to think about as they revitalize their policies.
okay.
Don, we got a question from Martin here that it's a favorite of mine. If you don't mind, I'm going to
please
address it, and we'll get into kind of some of the regulatory considerations later on. But Martin asks about when fraud models are non-FCRA compliant, not being able to decline off of them, and whether we should be building FCRA compliant fraud sources. So it's a great question, and for many reasons. One of them is, where does underwriting and fraud evaluation begin? That is a very difficult determination. I think, a lot of times clients will say, well, we want to use these to determine whether or not to approve an individual, approve the person. Like, can we use this data from an FCRA perspective? And it does depend on whether it's fraud evaluation or whether it's credit. And I would say, this is a facts and circumstances specific analysis. But if you're able to figure out where underwriting ends and where fraud analysis begins, I think that it is sometimes possible to decline off of non-FCRA compliant data, because you are not using it to make a credit decision in that case. The credit decision is already made. I want to extend credit to John Socknet. Now I just need to figure out if the person who's on the other side of this app is John Socknet. And if I'm not comfortable that the person on the other side is John Socknet, I'm not declining for a credit reason. I'm then declining from an identity verification, from a fraud evaluation perspective. And so I think that there are some ways that non-fraud data can be used to decline, so long as the systems are set up and delineated, what you're looking at, and that, yeah, I've done the credit underwriting, and I've now moved on to something else.
Thank you. Yeah, that was a great question. Great question. So, all right, we said we're going to do a deeper dive on 2 or 3. And the first one is, as you can see on the slide here, romance, imposter scams. Joseph is talking a lot about like unrequited love and stuff lately, but so I'm not sure where that's coming from. But Michelle, will you lead us off here? And again, the point here is to do a deeper dive, and including getting into some thoughts about prevention strategies and tools.
One of the things that we talked about kind of at the start when we were covering off on this was really that romance imposter scams are playing on that trust reliant piece of, I know who you are. I think I know who you are. And a lot of times what I think we're finding when we're sourcing that fraud or when we're identifying it is that it does play on the relationship as well that the bank has with their customer, and that belief that we are heavily encouraged to be customer service first and customer service friendly. And a lot of times in fraud, I wouldn't say have to do the opposite, but you do have to be discerning and transparent and ask sometimes the harder questions. And so a lot of what comes into catching this fraud is, hey, you can give fraud awareness campaigns and you can say, make sure you know who you're talking to. But what we forget about in romance scams in particular is that they do genuinely believe that they know who they're talking to. They're like, I've talked to this person on the phone. I've texted them unendingly. People are investing in these relationships. And so you have to kind of have some of those additional support channels for communication to call it out, to be able to say like, hey, if you've started a relationship and they're being super secretive about it, and there's always some request for money or access or something that comes with that, that's a sign, right? But the people who are living these experiences and losing this money and kind of creating that shame effect, it's not because they intentionally wanted to. It's because there's a set of circumstances that really kind of brought them into this fold and made it work. The other thing I think for banks on the other side is that a lot of times this fraud is happening multi-channel. Where it can be really hard to catch is that it does play on a lot of tools and a lot of layers to create the loss. So it may be that it may be what feels like first party fraud to one bank because their customer debits another account and then the money's gone before they know it. And then they have an unauthorized claim later down the road. It may be that their customer did in fact open the account and then has funds slowly go out, and those get put into another person's account who's subject to that fraud. And so understanding that those things happen through multiple pieces. I think some of the points that were made earlier around cross FI collaboration, I think that there is such a big piece of one of the things that I think we see is that what I've seen, at least in the maybe industry events that I've attended for some of the fraud and compliance stuff, is that sometimes we're a little hesitant to talk about what loss looks like. If you look at the industry and you poll, and I know this question sounds maybe a little facetious, what is a good amount of fraud loss? I know everyone's going to be willing to tell you it's $0, but it's not. So how do you define what that looks like? How do you understand the specific circumstances where you've seen loss? And then how do you collaborate as an institution to say, wait, how can we do that better? Do I have the ability to use the Nacha network to call someone about a hold harmless or get information about an ACH transfer that's happened? Stopping these scams takes a mixture of education, willingness to, make human outreach to have a hard conversation, but it also requires FIs to really coordinate together and have kind of those transparent relationships where they can work out what they can share in order to create a stronger case and kind of prevent loss.
One thing that I would add on this one too is this is an area, especially when there's an elderly individual involved, where states are very active. One complaint can get a state regulator to call the entity, the bank, the non-bank, fintech, whoever you have, to look at it on behalf of an individual. And so, and a lot of states have mandatory reporting requirements with respect to elder financial abuse. And even if in the instance there's a good reason for why it was not determined to be fraud, the regulator will ask, well, what's your elder financial abuse policy? Do you have, having a list of what state laws you're subject to on the elder financial abuse side, and having a policy for how you're going to assess whether something is subject to those state laws is very important. Again, it might not be something that's implicated all the time, but you get that one call from Maryland, from California, and being able to provide those to them goes a long way towards towards them moving on to somebody else, quite honestly. So
I think just
I'm sorry, Michelle.
no, you're good. Go.
The only thing I was going to say so it's interesting that there are about $1 billion of losses a year from romance scams. The median loss is $2,000. So there were about 60, call it 60 to 70,000 cases. So there's still whale hunting per se, but a lot of these are such small amounts that I think that Michelle brings up some pretty excellent points around when you think about the compliance angle and what are you willing to accept. It's an important point when if you take that number, probably 50,000 of these are under $1,000. It's just interesting when you think about what are you willing to change that versus what are some common sense things that can be doing to be preventing these much larger ones.
I think the only other point that I was going to add was, Joseph, to your point on the policies is kind of for FIs, they also have to make a decision about how they want to handle that balance of when you say no, right? Because there are points where you feel like you're stuck between it's my customer, it's their money, it's what I allow. And then at what point do I say, hey, I have a heavy enough belief that this isn't in your best interest that I feel comfortable to the point of reputation risk at the start saying, maybe I won't process that. If you want to do that, you've got to do it somewhere else because I'm not there. So having policies or ways to kind of have a position about what those triggers are is, I think, important here too for staff as well.
very important.
While people are thinking if they want to talk about this more, and then again, I'm going to ask a question I don't know the answer to, and I'm sure the data is there, but I didn't look. I'm a member of a credit union. I am treated differently by the credit union because of their philosophy about, given one, their business model, but two, customer service and focusing on the customer. And if I was a fraudster, I might be focusing on institutions that have maybe a more customer-friendly perspective and outlook. And I'm curious whether, by percentage, whether credit unions versus other depository institutions, like what the mix of how often they're victimized and the type of fraud that they're subjected to. But
it's a good question. I don't know that I know the answer to that one. So my history was working on the credit union side. So I think, on our side, I think banks and credit unions pretty equally will play into that relationship aspect of customer first. I think on the credit union side, sometimes you've got, again, there is always that kind of once member, always member, the aspect of kind of how you layer into the relationship and feeling like you maybe know everyone. And so knowing that you're kind of making a decision for someone, and I'm sure banks have many of these same relationships where you've worked with someone for 20 years and then you have to say, hey, I can't do that. Or I actually think in the banking side, sometimes it's a little bit harder because you might have the traditional banking relationship, but also the investment relationship. And you kind of have different parties who have different perspectives about how to handle what may happen. Credit unions can have their investment arms too, but I think you see that a little bit more on the banking side where I think there's a very hard mix, and it's why in some cases this is a little harder to stop because all of the parties are motivated to help their good customers do business in the easiest way possible while not inflicting too much pain at the same time. And maybe some of that is the perception of, is that pain or is that trust building? Are we, when we introduce steps that are, hey, I'm only going to call you from the app, or I'm only going to do something, is it friction? Maybe. But is it also something that is potentially an investment in bettering the fraud appetite for you and your customer? Yeah, might be that too.
Just on that, I think we also see this more common in community banks as opposed to as well as credit unions, where there is more relationship manager are more invested in success of their customers. But we also see or noticing a shift in trends where there is more proactiveness of putting out public service announcements and best practices, especially elderly scam and elderly fraud is on top of mind for credit unions and community banks as they are helping their communities to be on the lookout for some of the fraud trends. Some of the things that we have noticed, like data breach is one of the key drivers to social engineering attempts, and how does that translate into actually a scam or an impersonation scam or a romance scam is something that we've seen credit unions work with community law enforcement to create these educational content that can be disseminated through relationship managers, for example.
We could go down a long discussion about credit unions and then prudential historic regulators, particularly the smaller ones, and what that means. But I won't belabor it. Recognizing we still got a couple more we want to do a deeper dive on. This is one, just very quickly, if you'll just talk to us very quickly about this. I know you want to share a couple comments about some differences between traditional and deepfakes.
Yeah, this is just going back to what we covered earlier on the traditional fraud slide. Synthetic identity theft. Very specific signatures that you look for in traditional banking. SSN abuse being one of it. With other platforms, and this is where I think network effects really take a place here. Synthetic identities using deepfakes or AI generators that has been gaining a lot of traction. If we sort of really look under the hood, there is connectivity on how some of these digital first platforms where there is lesser requirements. So payment platforms or even so it's split pay or point of sale lenders platforms where there is less emphasis on SSN. We see a connectivity between those synthetic identities to the synthetic identities that are then created based on some of these exposed data assets. There's a connectivity, but there is also this bifurcation of how synthetic identity has been traditionally treated versus this new emergence of new type of technology.
Just to maybe take a step back, just because I know that we can all bring out a bunch of kind of like nomenclature. Synthetic fraud really is this interesting thing where I take my name, date of birth, address, and I take Michelle's social security number, or I make up a social security number, and I get approved by somebody. Maybe they give me a line of credit, maybe they let me open a bank account, and I'm a good actor there. And then they start reporting on credit. So then this fictitious identity ends up in the bureau. So that's kind of what synthetic is, just it versus third party is, Joseph's identity leaks in a breach and I take and create an account in his name. So that's why there's also less of a feedback loop of I'm not negatively impacting somebody's credit score. I think we've seen as a result, this is another area where Gen AI is good because you can pump out combinations of identity combinations to try to create accounts. And you can also think about washing bank accounts where there's value to you. If I open a bank account with a synthetic identity and I maybe put direct deposit there, it's pretty interesting when you then think about income verification or cash flow lending, that then I have like a cleaned account for that as well. So I just wanted to give some background on why these are useful tools for fraudsters. Then how we try to prevent it, we work with essentially tools to essentially look at combination matches of SSN with identity information and say, is this the best match? Or does this social security number actually belong better with another phone number and another name and email? So that's just a bit of background on what is happening here.
Yeah, and then that's a great point actually. And one of the things that we also urge our customers to do is run ECBSV checks to look for SSN matches, and that's been a great tool for the vast majority of SSN that's been verified. But then what about SSN that already been in the system that are synthetic identities? That's where Eli rightly mentioned, there are certain matches that you look for, SSN association with different data assets or different PII elements.
All right, on to the second of our three deeper dives, recognizing that we've got 10 minutes, so we might not do as deep a dive, but this is another important one. So Eli, you'll kick us off on this one.
Yeah, I think for here, really what I'd say is we've thought a lot about how do you bring infrastructure together to holistically think about people centric. What I mean is I think historically the way fraud models would operate was application centric. So you look at an application in a vacuum, and at each moment in a journey, you look at that. We think very uniquely, perhaps, about how do we tie together security authentication and the account creation phase. For us, when we think about these authorized events, we think a lot about, using new technologies such as passkeys, Apple's good rebrand of FIDO2 credentials. To if somebody's making a large transaction, can we have them re-passkey to verify the person creating the account's the person who's signed back in to authorize something? We've also seen some other pretty interesting, what we'd call interventions. Verify that you're on the same home Wi-Fi network, for example, when you create an account when you want to do something that's high value. So that's what we think about is how do we add smart, lower friction setups that give you a pretty high degree of cryptographic attestation that the person you want to be doing something's doing it. But at the same time, I'd put this in a similar bucket as some of the things we've been talking about earlier, such as Monzo Revolut saying that they'll only call you when you're in the app. I think that a lot of the preventions here sometimes aren't the fanciest. They're actually more basic. That they're making sure that you're aware. Chase recently had to add a disclaimer that the big seven banks did with Zelle, where when you go to Zelle, it says make sure that you've read these 4 things to make sure you're not sending it to the wrong person. I think sometimes it's less fancy tools and more just information and making sure that consumers are aware of when they will or won't be contacted.
I know Joseph had some compliance issues related to this topic he wanted to discuss. Before he jumps to that, Michelle.
No, I think Eli really covered this one overall. I think the other piece that we see from these is, again, the piece of kind of that debate that I'm sure Joseph is going to get into about what is the liability balance between these, who owes at the end of the day, and what are the obligations of each party in this, and when these happen. It's probably one of the more common calls that I'm sure banks and credit unions would get is, hey, I made a payment. Oh, wait, I want to reverse it. Oh, it's already gone. What do I do? And so that does play into the education, does play into the profile of how you look at the experience, because everything that Eli may show from the experience that that customer did the activity. But now where do you sit in terms of who owes at the end of the day and what your decisions are there? So I'm looking forward to Joseph sharing more on that.
Well, and I was just thinking though, as Eli was talking, because a lot of clients will call and say to, this is what happened. Now the person's challenging us and saying that our security protocols are not sufficient. And Eli is walking through these great things that exist that you can do and you can improve your security, because I'm always they do seem to have stuff. But then I'm also thinking, I'm the guy who gets caught by all of these. I only watch Netflix when I'm traveling, and then it's oh, is this device associated with your account? You haven't been on your home Wi-Fi network in a while. I'm and the app thing, I'm trying to do is authenticating this app that's on this other iPhone. I'm I don't have that iPhone anymore. So great security things, not potentially great for me, but it does go to, you have to be able to defend those that you have that security as well. And in those instances, you certainly can. It's going to prevent fraud, but also where's that mix with the user experience? But I think that's again goes to, and I think Michelle, you put it well, of what's the right number there that you can consider. With this one in particular, it becomes interesting because it varies based on product. Reg E for deposit products versus Reg Z for credit products have different rules for who's going to be liable in some of these instances. If a person provided their credentials to somebody else, even though the transaction ended up being fraud, it's not what they thought that they were authorizing. From a Reg E perspective, that person's out of luck. There are still, I'd say, UDAP considerations that you need to be considering, some other considerations, but from a strict regulatory perspective, that doesn't qualify as an unauthorized transaction if the person provided the credentials. From a Reg Z perspective, I think that there's a little bit, the language is not the same. You might have a little bit of a different piece of, sure, I provided the credentials, but I didn't authorize this particular transaction. That could be something that's considered there. So looking at what does authorized mean in these different ones is, I think, a product specific evaluation and how the person has done it. And when you think about the security requirements. That's one where being able to defend things is the important thing that you have to be able to do. And the industry continues to evolve with that, as Eli was going through.
Well, we've kind of morphed into this next slide anyway, so let's, given some of the limited time here, right, Michelle, this I know you wanted to share some things, and again, I know we've talked about some of this, and still a couple more slides to get to, but you want to hit some high points here for us.
Yeah, I mean, really at the high level, I think this group has covered a lot of this. I think that ultimately the risk dilemma is really that balance. It brings us back to kind of the start, what am I willing to take on from a reputation risk perspective, knowing that in social media day to day, you can be on the front page of Facebook or Reddit or anything else anymore. In terms of, a bad interaction that you have that escalates. I think understanding that fraudsters know that and do play on it, and it kind of highlights the importance of the collaboration between your compliance, your legal or your risk teams and your fraud teams, because a lot of times they're going to be put in a position to make a decision about how do we feel about it. And then there is a little bit of that element of UDAP in the sense of, well, if we make an exception because this person is particularly loud or threatening about it, now what do we do about all the others too? So there's a really kind of, I would say, messy, sometimes a little chaotic decision to be made there. And so the more that you can kind of define what those variables are, help you to really kind of figure out how to handle this. And the only other point that I would make, and I think I do it for all the fraud people I talk to every time, is this really is a level of investment. At the end of the day, banks, any financial institution has to ultimately decide, what am I willing to invest in my program in terms of my risk profile? How do I think about it? Because there is tools, technology, process, people. There's, as Eli has pointed out, as the team has pointed out, there's a number of fantastic tools out there, but you've got to be willing to invest in them, and you've got to be willing to put the dollars where kind of your risk perspective and tolerance is. So yeah.
Okay. The slides here, we're going to skip 13, 14. The last one, we're going to do a deep dive. We can only get into the shallow end here, is AI-powered scams and deepfakes. Lob, you were going to tee us up on this one, and then if we'll do it quick, and then I want to get to the last two slides, which is, okay, now what? What do we do?
Yeah, just quickly on this slide, as everybody on this panel has pointed out, a big rise in AI-powered scams and deepfakes. It all comes down to investment on resources, identifying the right touch points on where AI, these type of scams impact, not only at new account origination, but also throughout customer life cycle. Where are some of the gaps where for us to exploiting? Again, all of this is an enabler of traditional ways where scams happen. This is more of a means to an end rather than something that is on its own standalone has a lot of validity. So looking at just traditional ways on controls on dark web breaches, and then just behavior of identities when they change out of normal. So looking at transaction monitoring, that all of that is sort of an essential tool to have those indicators into, if this could be really an AI-powered or a deepfake scam. There are discriminator models that are available to identify deepfakes, but I think those are, again, everything is so much closer to each other now. There are just splitting hairs at this point. So adding additional context is essentially is essential in at least in my opinion.
Okay, thank you. E-commerce fraud. So regulatory risks, right? I mean, that's the overhang or the underhang, right, of all of this, is that there's always, beyond the economic loss, the direct economic loss there, and reputational risk, there's also get in trouble with your regulators. So Joseph, you can do this in like 90 seconds, right? I mean,
I can do this in 90 seconds, absolutely. It's 2 slides. But it's similar to what Nalab, Eli, and Michelle all said. That it's a spectrum. It's the level of investment. I think that's both for the. I think John and I always say that we cannot eliminate regulatory risk. We're in the risk mitigation world too. So you have a lot of possible considerations here from a regulatory perspective as you're looking at fraud prevention and addressing fraud just generally. They're on this slide and the next slide. But as you think about that spectrum, you kind of think about it as 3 levels. One, knowing the law. 2, having the policies and procedures in place, identifying how the entity is going to follow those laws. And 3, like how you're actually following those laws, the number of people, like what you're doing. And I think that at each 3 of those, you have levers that you can kind of like decide where you want to go. I think knowing the law, having policies and procedures, those are important because they protect you if you get questions. That it's like, wait, you don't have that? And that starts going down other things, from a regulatory licensing perspective. John, I'll get into that, like something that's just one complaint turns into a full-blown exam by not having a policy or procedure. Being able to respond, I think, is most valuable. But again, there's levers within each of those. Do you need a full 50-state survey on something that's going to happen once it's a once in a 100-year event type of thing? No, probably not. But the things that where there are more risk, make sure that those things do exist. But again, like everybody else was saying, it's a spectrum. But with that, I'll turn it back to you, John.
Great. So we're out of time for additional questions, comments, and discussion. I'd be remiss if I didn't remind everybody about what's coming up next month. Hope to see as many of you all there as possible. Michelle, Joseph, Deval, Eli, thank you so much. Great presentation, great discussion. I know we could have talked for a couple more hours on this and only scratched the surface, but again, on behalf of the audience, thank you so much. Enjoy the rest of your day.